or good afternoon if you're on the East Coast. Thank you for joining today's webinar, Hidden Treasures in the Tax Code, featuring RESAS Marketplace partner Taxbot. I'll be co-hosting your webinar. I'm Rochelle Brempong, Digital Content Coordinator at RESAS. We'll be hosting the webinar with Sandy Botkin from the Taxbot team. Today's topic is definitely going to be an exciting one. Sandy's going to be debunking some common myths on what you can and can't expense, and more importantly, how you can expense things like barbecues and pool parties. Just a few housekeeping tips before we get started with today's webinar. The webinar will run for 30 to 45 minutes with some time at the end for Q&A with Sandy. Questions can be posted in the chat box to the left of your screen. Should you have any technical difficulties like audio lagging or video lagging, just let us know through the chat box. And of course, we want you to share your thoughts and any additional questions that you might have. You can use the Twitter handle @RESAS or @Taxbot and use the hashtag #REEducation. Also, I'd just like to remind everyone that we will be sending out an audio recording of the webinar to everyone within the next few days in an email, so just look out for that. All right, let's get started. Just giving you guys a quick introduction on Taxbot. For those of you who don't know, Taxbot is an app that provides you with tools to track your business expenses in both CRA and IRS compliant manners. This means that Taxbot provides you with an easy-to-use tool that will automatically identify your expense activities, track them, and help you earn expenses back. And just a brief introduction on Sandy Botkin. Sandy is the #1 tax coach and CPA attorney with over 30 years of training experience. Sandy has been featured on Fox News, CNN, and taught business seminars with renowned business coaches such as Tony Robbins. He's even worked with the Internal Revenue Services of America, or the IRS, training their agents. Sandy has also served as a professor at universities throughout the United States and has authored a number of publications and books. Sandy, it's great to have you on the webinar. I'll hand it over to you.
Well, thank you, Rochelle. I got to tell you, it's great to be here today, and I am absolutely jazzed that everybody's here. I am very privileged to be working with RESAS, but I'm very honored to be speaking to all of you, self-employed individuals. My parents were self-employed. I'm self-employed, and I've always admired anyone who's willing to take a little more risk in order to make a lot more money. Now, a little background about me was mentioned by Rochelle, but I thought I would just give you a little more expansion. I'm a tax attorney. I'm a CPA. I'm a best-selling author of a book called Lower Your Taxes Big Time, and I have another book that just came out that's garnering great reviews called Achieve Financial Freedom Big Time. I'm a former trainer of the IRS agents in Washington, D.C., so if you think of an IRS personnel or a CRA personnel as a rat, I guess that makes me head rodent. I've taught well over 100,000 people live throughout my seminars, and I'm really passionate about showing small business owners, how to wake up and realize that they're overpaying their taxes, which is what we're going to be getting to today. Now, this will be recorded. This is a very content-rich program, but you will be getting a recording. I do want to know that, but if you want to write this down, take notes, it might be a good thing to do too as well. Believe it or not, one of the most successful ways to grow your business is to bring a little food and a little fun to the table. The question is why? Do you want to know why? There's a famous guy who's an author. His name is Robert Cialdini. And Dr. Cialdini is one of the leading social scientists that studies human behavior. And specifically, he studies persuasion tactics. And he studies what makes some people such good salespeople, politicians, and leaders. And in his research, he discovered something that he calls the law of reciprocity. And what that law says is when we perform a small favor or gift to another person, they sort of feel a small sense of obligation to us. Makes sense, right? That person will often respond more favorably to a future request from us in return. And that also makes sense, I think, right? Salespeople have used this technique for thousands of years, and I would bet most of you have bought lunch for a prospect in order to maybe butter him up during the sales process. This has been done since the beginning of time. And why? The answer is really very simple, because it works. Let me move on here. And I want you to visualize a stereotypic business meeting. And I want you to get that picture in your mind. Now, many of you are probably visualizing a meeting in a conference room or at a restaurant, but maybe you could have also thought of a meeting, say, on a golf course, because they're both considered business meetings. So here's your marketing tip. If you're trying to close a sale, the the law of reciprocity will very likely increase your chances of getting the business if you pay for lunch. Now, you've probably been on the receiving end of this as well. When someone buys you lunch, don't you feel a sense of gratitude and a desire to return something in the same way? By the way, it's interesting to note, it's not just salespeople that understand this concept. Politicians and lobbyists use this strategy all the time to get legislation passed. I see it all the time in Washington, D.C., where they're taking congressmen out to various restaurants. And here's the important point. Politicians understand the power of meals and entertainment. And because of this, there are provisions in both the U.S. and Canadian tax code allowing businesses to deduct these costs. And that's why you can benefit too. And I do want to emphasize, I'm going to be covering both U.S. and Canadian strategies. I'll be focusing mostly on U.S., but where there's a difference, I'm going to point that out as well. So for you Canadians, you will be seeing this, okay? Now, today's webinar, you might be wondering why I gave that as my marketing tip, because it's all about deducting both your meals and your fun and entertainment. And I estimate this deduction will save you, depending on your lifestyle, somewhere between $600,000 and $7,000 in taxes. As I said, depending on your lifestyle. So we have a lot to cover. But before we can cover some of the more powerful yet unknown strategies, I want to cover some of the basics. You got to start with the basics. First of all, a little bit our agenda, and I want to review what we're going to be doing. We're going to be talking about some dangerous myths about deducting your meals that most people believe. We're going to be talking about some very simple tricks to turn almost any meal into a tax deduction. If you're not doing this, you'll lose your overpaying your taxes. You're overpaying by thousands, and I'm going to prove that to you today. We're going to talk about a unique way to write off the cost of barbecues, pool parties, and other home events with neighbors and friends in both U.S. and Canada. We're going to be talking about how to make your meal 100% deductible instead of the normal 50%, which is the normal rule in both U.S. and Canada. And by the way, I want to give you a hint. If you think you know this, you're probably wrong, and a lot more. I want to emphasize that this program is very content-rich. There's a lot of stuff I'm going to be covering, so grab a pen and paper or take some notes on your computer. But the good news is we're going to be sending out a replay. All right, so if I move too fast, don't worry. You're going to still be able to focus on the information and be able to rehear it. So I do want to emphasize this. And at the end of the webinar, I'm going to take somewhere between 5 and 8 minutes, show you a quick demo of how Taxbot, our mobile app, can help you take advantage of what we're going to learn today for you to find more deductions, to save money on your taxes, and to bulletproof you against even the smartest IRS auditor and Canada Revenue Agency auditor. Sound fair? And by the way, after the demo, I'm going to open this up for some questions. So please write down your questions. Do it as soon as you can, and we will take that at the end as well. So let's dive in. Let's get ready here. We'll get to the general rule. The general rule, and this is the basics of entertainment, which is the same in both U.S. and Canada, is that you can generally deduct 50% of your meals and 50% of your entertainment. It used to be 100%, but in 1997 there were some changes made in both U.S. and Canada. That number dropped to 50%. However, there are some exceptions to the rules where you can deduct 100%, and I will get to this later in my presentation as to what those exceptions are. Now here's a simple trick to turn almost any meal into its tax deduction. Now to do that, you need to answer a question for me. Who are your potential customers for your business? If you're a real estate agent, it could be anyone, right? It could be adult siblings. It could be family members. Your friends might want to buy or sell their home someday. Shelter is necessary for everybody, okay? Let's say it could be your adult siblings or family members. Anyone who wants to buy anything or can give you a referral is a potential prospect in your business. So my question is very simple. If everyone is a prospect, how can you ever have a non-deductible lunch? You can't. And if you're not writing off almost every meal you have with someone, with very few exceptions, I would like to suggest that you are losing money. It's that simple. In fact, I can even keep going. Might not your old college roommate be a potential prospect? Can't they refer you someone? Absolutely. So the trick is, here's the bottom line, plan to talk business at every meal and document the discussion according to both IRS and CRA guidelines that I'm going to be giving you today. Now, I once posed this question to an IRS commissioner, and this is when I worked at the IRS, and I asked him, if everyone is a prospect, how can you have a non-deductible meal with another person? And he responded that if a person went about it correctly, they couldn't. So almost every meal you have with someone is deductible if you do it correctly. and we're going to get into exactly what you need to do. That's the key. So what do you need to do? How do you do it correctly? The key, frankly, is planning. If you pre-plan a meal and let the other party know in advance that you want to talk about business, there is absolutely no time limit to the discussion. And the key is to pre-plan. You can't just go to a restaurant and sit down and start talking business with the waitress and write that off. That won't work. You also have to have a very specific discussion, either before, during, or after the meal with your prospects. When I say specific, I'm not kidding. If you simply say the word prospect, that isn't specific enough. Goodwill isn't specific enough. So let me give you some examples of specificity. Talked about a referral. Try to get a referral. Talked about an inspection at 301 Main Street. Talked about pre-qualified buyer, pre-qualified seller. Okay? Even if you only spend a few minutes talking, there's no time limit. But you've got to write down in your tax organizer or tax tracker, and that's the key, that you had a specific discussion with someone. Mentioning that you want to talk business is absolutely the key and is critical. Now let me give you a few examples. Suppose your neighbor is a server at the local restaurant. All right? If you, as I said, if you simply sat down to the restaurant and talked business, that's not deductible. However, if your neighbor says, I'm thinking of selling my home, I can't talk now. Can you come to the restaurant during lunch, and then we can discuss it? Would that be a pre-planned meeting? Yes. And therefore, would it be deductible? And the answer is yes. That's really the bottom line. It's a good distinction. Here's another example. Let's say you go to lunch by yourself, okay? But you have an intent to meet people there and talk business. And there's some businesses like that, like home-based businesses that encourage that. You might get business, but it's not deductible because you didn't have a pre-arranged meeting, okay? That's really the bottom line here. And how does IRS know you had a pre-arranged meeting? They look in your appointment book, and they look in your tax tracker or tax organizer. Here's another question. Does it matter where you eat? Actually, it does. The maximum of real estate, as you know, is location, location, location. And this really also applies to deducting meals and entertainment. As we've learned, you must talk business during the meal. Therefore, your meal must take place in an environment that's conducive to a business setting. You can't have any distractions like floor shows while you're talking. It's got to have some quiet time. In fact, what the regulations say in both countries is you have to have a long, hard surface between you and your prospect where you can get a contract signed. Where can that be? It could be a table. It could be on a chair. But you've got to have some hard surface where you can get a contract if necessary. And by the way, do you have to get a contract? No. Not all marketing works. Another good feature of good location is, as I said, has to have a hard, flat surface. But what about if you go to a bar? Is a bar a good setting? And the answer would be yes. You can actually have it as a bar as long as there's no distracting events like bands playing and things like that. I mean, you really think the government's going to disallow meals at a bar? There's no way. And by the way, that's also true of liquor. Liquor is just as deductible as food, so I want to emphasize that. Now, let's talk about something else. In both countries, there is something called associated entertainment. When I first say that, people think I have two heads. I want you to write down, and this is what it says in the Internal Revenue Code. I want you to write down the word associated entertainment. And then I want you to put an equal sign. And I want you to write down the word fun. Fun. See, we don't need better tax laws. We need better explanations. We have great tax laws. And, for example, with associated entertainment, what are some things like fun? Plays, movies, hockey games, football games, ballet, symphony, theater. All of those things can be deducted. And what can you deduct? In both U.S. and Canada, the general rule is 50%. So if you spend $100 on the theater or football games or hockey games, you can deduct 50% of that, or $50. The key, what do you have to do? And here's the exact rule. This is now not Sandy Bodkin talking, but this is IRS or Canada Revenue Agency talking. The key is you've got to talk business either before or after the event. Before or after. Discussing business during a NASCAR race is going to be kind of difficult. So before or after the event. That's all you have to do. And it has to be done within the same 24-hour day as the event. Does that make sense? So let's take an example. I talk to Rochelle. I go to Rochelle's home, and let's say she's in Vancouver, and we talk business, and then an hour later we drive to a hockey game. Is that talking business within the same 24-hour day? Yes. Let's say Rochelle and I have lunch, and then I say, Rochelle, what do you say we go play golf, which is right after the lunch? Is that talking business within the same 24-hour day? Yes. So the key is the same 24-hour day. I want to emphasize something here. In a fairy tale Cinderella, she had to leave the ball by midnight. In tax law, you basically have to get your discussion done before midnight on the same day as the fun generally. If not, coaches turn to pumpkins, and unfortunately deductions vanish into the night. So you want generally the same 24-hour day as the fun. So let's take an example. We have lunch, and then I say to Rochelle, what do you say we go golfing? And we do. We play golf. She might have a 300 handicap. She's going. Is that talking business within the same 24-hour day? Yes. Let's say we have a business meal, and then we both go home. And now the next day, maybe I meet her next day for dinner, or not even dinner. We just go out and have fun the next day. So I had dinner today, and then we go have fun, maybe at a hockey game tomorrow. Is that talking business within the same 24-hour day? No. Got to be the same day. Let's say we have a 1-hour drive to a football game, and in the car we talk business, and I had the intent to talk business with her in the car. Will that qualify? Yes. Okay? See, when you know the rules, it's easy to win. It really is. Now, there's a warning I want to mention, and this is a very serious subject I want to talk about. Most people have their heads in the sand on this subject, and it can be very dangerous. So pay attention. Deduction from meals and entertainment have to be documented according to specific government guidelines. I mean, let's face it. If they're willing to, we have good tax laws. You can eat away your taxes. You can drink away your taxes. You can play away your taxes. So the government wants you to do it right. That's why I always say the government's the biggest bookie in North America, because they subsidize you in doing it. But you got to do it right. And let me give you a little bit of a metaphor. I love to watch crime-solving shows and courtroom dramas. I'm sure you probably do. Maybe you've seen it, like Law and Order, SVU, and so on. And there's a common theme in almost every one. Someone gets accused of a crime. Now, what is the first thing that the suspect is asked by the police? What do they say? Mr. So-and-so, do you have an alibi for the last night around 10 p.m.? A good alibi can make absolutely sure that your charges don't stick. A good alibi is exactly what you need to prove your innocence. I can't say that enough times. In criminal law, we know that we're innocent until proven guilty. But when it comes to tax law, it's a different story. In tax law, the exact opposite and true. You are considered guilty until you prove your innocence. Why? Because, as I said, the government gives us great tax laws, but we have the burden of proof. We do. It's not the government. We do. And it would take too many resources to police it 100% of the time. So they do spot checking on audits. And they trust you to gather up the proof, but it's up to you to prove that you're compliant with the laws. And now the good news is that the tax codes in both countries are very clear on what you need to do to prove your deductions are legitimate, to prove that you have an alibi, even if you get the most scrupulous auditor. And by the way, I'm going to assume that you get the smartest, most scrupulous auditor around. That's what this entire program assumes. And I'm sure you'll hear people who said, I didn't have anything and I got away with it. There are various types of auditors, but I'm going to assume you get the brightest information, the brightest auditor around. There are essentially 6 things you have to have in both countries in order to legitimately take the deduction. It's very simple, and it's very easy to do. You have to have a written record of these things. Now, you might hear me refer to this as a tax diary, tax organizer, or tax tracker. They're all the same. I do want to emphasize that most accounting programs do not focus on tax compliance. So things like QuickBooks do not focus on tax compliance. We actually built our software, Taxbot, to make it simple and easy to keep track of the information you need to be compliant with the agencies. So what you need is to write the stuff down that I'm going to be talking about in a good tax tracker or organizer. And what you need to write down is what I call the 5 W's and an H, otherwise known as the 6 elements of substantiation. So what are these? First, who did you meet? What's their name? James Taylor. What type of expense was it? Was it a meal? Was it fun? Was it a business gift? What was it? A product sample. What was it? Number 3, where did the expense occur? I went to Outback Steakhouse or Tim Hortons. Number 4, when did it occur? What is the date? They don't want the time, but the date, although a time might be nice too if you have it in your diary. And number 5, why? This is something that's very important. You want to be specific. Ask for a real estate referral. Try to get a listing. Pre-qualified buyer, pre-qualified seller. Talked about inspection reports. The point is why? Be specific. And finally, how much? What did it cost you? By putting these 5 things and how much, you will never have to worry about an IRS audit again or a Canada Revenue Agent audit again. And what's that worth? And by the way, a lot of times people ask me, will IRS or Canada Revenue Agency believe everything I say in my tax tracker or tax organizer? Yep. Unless they can prove fraud, they will believe everything. And by the way, I want you to notice something. Some of this information might be on your receipt, but other items is not included. These 6 elements must be presented for every meal and entertainment that you deduct. No exceptions, no ifs, no ands, no buts. If you leave out some of these, you don't get the deduction. It's that simple, okay? And I want to elaborate briefly on a business purpose. Remember I said a very specific business purpose. Which do you think, now you're on the jury, which do you think would be a more believable alibi in a TV crime show? A, I was at the movies. Or B, I went to see the 10:30 showing of Star Wars with my friend Johnny. Now, what do you think? Clearly, the second one. Why? Because it has more detail, okay? That's the bottom line. That's the way you want to think. You want to think like a prosecuting attorney marshaling the evidence. So you should try to be more detailed in your prospecting as an explanation is weak. Demonstrating the benefits of XYZ product is strong. Sometimes people ask me if I write down my alibi in a tax diary, will the government, as I said, believe me? And again, what's the answer? Yes. By regulations, they have to believe your documentation as long as they can't prove fraud. Your tax tracker is your audit insurance against IRS. And all of you have homeowners insurance. Why? You don't use it that often. But if your house burns down and you don't have it, it's a disaster. You have car insurance. Why? Because you get into an accident. Without it, it's a disaster. You know, many years ago when I was at the IRS, there was a case of a gentleman that was being audited for his automobile mileage. It was 2 years prior. He tried to be sneaky, and he hadn't kept good records. So what he did is he bought a diary, and he used 6 different colored pens to backdate his mileage next to his appointments. Some of the pages looked like they were dragged through the mud. Agatha Christie and Ellery Queen would have been proud. Except one thing. He used a 1996 diary for 1994 expenses. Okay? The point is, obviously, you don't have to be that smart to realize that there was a real problem there. All right. Let's talk receipts and some of the misconceptions about them. Do you need them or not? For almost every deduction, you need to take a receipt. Yet there's a very strange rule in the United States for meals and entertainment. With these, you're not required to have a receipt if the expense is less than $75 per item. It's not true in Canada. You must have a receipt for everything. But in the United States, if it's less than $75, you do not need a receipt. Okay? But I got to tell you, although you don't need a receipt under $75, auditors love looking at receipts. It kind of looks kind of fishy if you have receipts for everything except for meals and entertainment. Now, in addition, even if you don't need a receipt, you still have to have the 6 elements of 6 elements of substantiation, which means the 5 W's and an H. So I recommend you keep receipts anyway. Let me give you an example. Matt and Jake discussed business over some pretzels, which cost $14. Hopefully those are good pretzels. Do they need a receipt? No, as long as they have the 5 W's and an H. Who, what, when, where, why, and how much. They are absolutely bulletproof from even the smartest IRS auditor. Here's another example. Dave and Scott talk shop over dinner. The bill and tip comes up to be $75. Do they need a receipt? Absolutely, because it's $75 or more. That's really the bottom line. Again, for you Canadians, you have to have a receipt. Doesn't matter. There's no $75 exception for you. It's only for the Americans that have this. All right. Now, I'd like to discuss some common myths concerning meals and entertainment. You know, many times I hear in order to deduct the cost of a meal or activity, I got to pay for the other person. You ever heard that? This is absolutely not true. Years ago, there was a rule about splitting a meal, which is also called Dutch. And it was very tedious and it was complicated. There was a complicated equation for calculating how much the meal you could deduct. But finally, the governments have simplified the rules, and now it's pretty cut and dry. Here's the rule. You can deduct 50% of your cost, period. Whether you just pay for yourself or you pay for other people, 50% of whatever it is you pay. That simple, okay? If you pick up the whole tab, then you deduct 50% of the whole tab. So that's simple enough. Now, one question I get a lot of is, Sandy, I have my spouse who works with me in my business. Can I ever take my spouse out alone and talk business? The answer is very clear-cut. Absolutely not. You can never go out alone with your spouse because IRS has what is known as a closely connected spouse rule, at least the IRS, and Canada too, by the way. At least they agree that your spouse is closely connected. Is there any way to take out a spouse? Yes. How can you go out, how can you entertain multiple people, let's say another couple, if you don't have somebody to keep the other person busy? So IRS and Canada Revenue Agency says whenever you're entertaining another couple, you may always bring your spouse and busy, okay? And how does IRS know, or Canada Revenue Agency know, that you're entertaining another couple? They look in your tax diary or tax organizer. It's that simple, okay? That's how they know. Remember I said they will believe everything you say. By the way, here's another interesting thing, another bunch of questions I get. Can I deduct my meal with my spouse if we work together? Absolutely not. Meals alone with a spouse is not deductible. What happens if we're partners in our business? Answer, absolutely not. You got to have another couple there or other people there that your spouse is needed to keep them busy while you talk business. And that's really the bottom line. Okay? Now let's talk about season tickets. Do you have any season tickets? The rule on season tickets, and I met somebody who has, I think they go to a hockey game, what was it? It was a football game, and they can go 8 times to the football game. The way it works is that every event stands by itself. So let's say in this example, we're going to use 10 games. So you have 10 individual opportunities to deduct each game. So if you go to 8 games and you talk business, and the other 2 games you don't talk business, then 8/10 of your season tickets times 50% is deductible. Again, everything is times 50%. By the way, it's based on the face value of the ticket. You cannot deduct scalper's fee. So if you end up buying a ticket to a concert that had a face value of $100, but you bought it from a scalper for $200, you can only deduct 50% of the $100. You can't deduct the scalper's fee. So I want to emphasize that. Now let's talk about business gifts. That's another big thing. And again, this is all being recorded. You're all going to get a copy of this recording. I do want to emphasize this. I know I'm going quickly because they've given me a limited amount of time, plus they want me to answer questions, so I'm going to be really moving here. The business gifts are great. There are basically 2 ways to deduct gifts that a lot of people don't realize. One is to deduct it as a business gift. The problem is that there's a limit. And they did it during a year of tax simplification. So whenever you hear that word, you know you probably got nailed. The limit is $25 per person per year. And a married couple count as one person. So if the face value of the ticket was $100, guess what? You can only deduct 25 of it. In fact, even if you gave the ticket to the couple, your maximum deduction is $25. So here's a powerful tip for entertainment. The government allows you to treat tickets as either a business gift or a gift of entertainment. There's 2 separate rules. So the better idea is to treat it as entertainment. Why? Because when you treat it as entertainment on your tax return, you can deduct 50% of the cost of the gift with no limit, no maximum. So let's take that same $100. If you treat it as a business gift, it's limited to $25. But if you treat it as a gift of entertainment, you can deduct 50% of that $100 or $50. You get double the benefit. If the face value of the ticket was $300, then you can write off $150, which is much better than $25, right? And by the way, certain types of businesses, like mortgage brokers, are restricted by the federal government for giving gifts. So the IRS doesn't have a problem with this, but other regulators might. You might want to check about this if you're in a regulated business. Now, there's an old saying, pigs get fat and hogs get slaughtered. You want to be aggressive, but you don't want to be greedy. There was a gentleman by the name of Doc Sutter who tried to write off $35,000 of business meals in a year. I think he wrote off, it was like 1,200 meals or something like this. The IRS disallowed everything, and he went to court. And he argued, I only eat for business reasons. Do you believe that one? How's that for a claim? Obviously, it isn't true, and the court found him guilty. As I said, I suggest you be aggressive, but follow the rules. Don't get so greedy that you do something dumb like Doc Sutter, okay? Now, here's another interesting thing. I promised you earlier that I would teach you some unique spins on deducting meals and entertainment. Let's talk about a unique way to write off the cost of barbecues and pool parties and other home events with your neighbors and friends. There's a provision in the tax code that allows you to apply the same entertainment rules when entertaining at home. It is just as deductible as going to a restaurant, okay? The important point is that the events have to have a business purpose associated with them. And here's a few scenarios that might help you take advantage of some of these opportunities, okay? The provision in the tax code, as I said, that allows you to do this. Janice is a good example. She's a real estate agent. Let me get to the slide that I want to be on. Here we go. And she's celebrating 2 years for being in business, being an agent. And above the food, she had a little party, and above the food, she had pictures of all of her listings that she wanted to sell. Essentially, she was advertising her properties. In fact, I've actually attended a celebration of a personal friend that did this, which gave me the idea. My friend had taken photos of her listings and placed the signs on easels near the food. This created an alibi that the auditors couldn't refute. I was very impressed, I have to tell you. Another idea for Janice to invite people over for a quick presentation on home values in her neighborhood, followed by a pool party. Now, obviously, she should ask for their business as part of the presentation. Here's another example of a financial planner where they invite people from the neighborhood over for a quick update on stock market or current financial scams, followed by meals and entertainment. Again, they can deduct 50% of that. But the important point is you need to document the 5 W's and an H. And I strongly recommend you take pictures of any products or photos displayed at the event. If you follow the guidelines, you can deduct 50% of the cost of the event just like you would in a traditional setting. I want to emphasize that. Now, a word of caution. Make sure you don't mix your personal celebration with a business party. For example, mixing business with your nephew's birthday party is not okay. Not only is it inconsiderate to your nephew, but the auditors won't allow it. Things like birthday parties and bar mitzvahs won't go over well if you try to mix business and pleasure at the same time. So be aware of this. You want to make it business. Now, there are some unique and powerful ways to deduct meals and entertainment. Let's take events like business anniversaries, client appreciation parties, prospecting events are perfect candidates. You can even throw a Super Bowl party and watch a per-pay, per-view boxing match, for example. You just make sure that there's a business purpose behind the event. You can prove that it's for business by simply sending out letters saying, for example, you're celebrating 12 years in business. That establishes an agenda. If you post signs showing your inventory with prices above the food and take pictures of people looking at these pictures, this is a proven way of showing that your primary purpose of the event was business. Think about that. Now, when we talk about the 5 W's and an H, one question that always comes up is how to document the how much. Simple question. It's a good question. You know, if you're planning this in advance, it would be wise to get a separate receipt from the grocery store and for the food and the supplies and entertainment and things you used at the party. With this separate receipt, it's nice and clean. But another method would be to use a highlighter on the receipt to identify which items were for business. But here's the question. What if you're using food that you already have in your pantry for which you no longer have a receipt? Well, remember our $75 rule? In this case, a reasonable estimate will do just fine. Just make sure it's under $75 for the total if you don't have a receipt to back it up. And by the way, a little word to the wise, do not have all your home entertainment be $74.99, okay? Now, the next strategy is one of my favorite ones. I told you I would teach you how to make meals 100% deductible instead of 50%. Well, are you ready to learn how to do this? Seminars and sales presentation enjoy a 100% deduction. That's right. This doesn't have to take place in your home. It could, but it doesn't have to. If attendees are there to hear a seminar or a sales presentation, that's the important point, then the food and incidentals are 100% deductible. And it's very important, by the way, to distinguish between sales and training. If the intent is to make a sale, then the event qualifies for a 100% deduction. If the training session then it doesn't have an immediate goal as a sale, then it qualifies for a 50% deduction. Now let's differentiate these with some examples. And I'm going to be using some examples from a variety of industries just to make my point so you understand what I'm saying and what the difference is. A realtor, for example, may be building out a team of salespeople to work under them. If they invite candidates to an event to train them on their system for selling, that would be a training event, and that's only 50% of the food would be deductible. But if, however, they invited their neighbors over for a class on how to buy investment property, it could be 100% deductible if their event was to convince the attendees to hire them as their agent. That's a big distinction. A financial planner could invite people to come over to his presentation on how to retire like a king on a teacher's salary, for example, with the intent of getting a contract to manage their investments. Again, the key is to try to get a sale, not just training. A direct salesperson, and this is a nice, simple, straightforward approach. The prospects, let's say the prospects are coming for the information. They're not coming because of a pool party or barbecue. This is coupled with an intent to make an immediate sale to get 100% deduction. So if you have you have a home-based business, like a network marketing business, you're inviting people over for a presentation, that is 100% deductible. And this is one of the most underutilized deductions. It's a very brilliant sales strategy to grow your business because it could be 100% deduction. Now, another 100% deduction scenario, let me go to the next slide, may not apply to most of you, but if you have employees, you can deduct the full cost of parties. With employees, and that includes members of the family, you can celebrate anything, birthdays, baby showers, holidays, year-end celebrations, all of those things. Almost anything you can conjure up. The only rule is that every one of your employees must be invited. You can't discriminate, okay? And that includes their families. You can't even invite their families. So all employees must be invited if you want that 100% deduction. Now, and finally, if specific types of entertainment are directly connected to the business promotion, you may be able to deduct 100%. Now, what does that mean? Let's take an example. Let's say you're a professional movie critic. You have to see movies to review them, don't you? In this case, the movies that you have to review would be 100% deductible. A golf sales rep who sells golf clubs and plays a lot of golf and does golf demonstrations or golf training should be able to deduct 100% of the green fees, golf balls, and caddy fees. A travel agent could deduct the full cost of meals if they're investigating places to send their clients. And, of course, in order for all of this to stand up as an alibi, the agent should document that they eventually sent their customers to places they were investigating. I mean, you can't keep investigating cruise ships and never sell a cruise. That could be a problem, okay? So you want to show that you do those things. Let's talk about country clubs and health clubs for a minute. According to the tax codes in both countries, you can no longer deduct the cost of country clubs and health clubs outright. However, there is a strange provision that allows you to get a deduction for these kinds of clubs if the company reimburses employees for the dues that are used in business. And this works by treating it as a fringe benefit for the employee. So here, you really have to be a company, like a corporation, if you want to do it for yourself. If you're self-employed, you're not an employee. And I think a good example is in order. Phil is an employee of Widget Company. He is provided with a country club membership worth, $20,000 by the company. If he can prove that 60% of the time, and he uses his tracker for this, he uses the club for business, he can exclude 60% of the $20,000 cost from the club as compensation. So he'd only have to claim $8,000 as taxable compensation on his tax return. Widget Company, however, can deduct the entire $20,000 cost. And by the way, there's nothing magical about the 60% number I used. I just use it as an example. If the employee uses it 100% for business, then they wouldn't have to claim any of the $20,000 as compensation. If they use it 30% for business, then the employee could deduct 30% from the cost of his take-home compensation. In all cases, however, the business gets the deduction for the full $20,000. If you did have employees, this could work for them. You could also take advantage of this, as I said, for yourself if you're incorporated and you're an actual employee of that company. Now, I bet you never heard of this one. This is the power of deducting meals and entertainment you'll find is rarely maximized by self-employed people. But it's one of the deductions that is tied directly to your sales and revenue growth. So it is absolutely important to understand what we're talking about. And we talked about the importance of an alibi, by the way. And I would love to take 5 minutes and show you how my company, Taxbot, can be a constant alibi for you, even against the smartest, most persistent auditor. And after that, we're going to open up the lines and take some questions. And by the way, when we talked about having a good alibi for expense tracking earlier, I mentioned that you could have a good diary or a good tax organizer. We learned that most expense tracking and accounting software was not built for tax compliance. I want to emphasize this, and I want to talk about that for a second. If you get audited and you show up with an accounting program like QuickBooks, the agent, if he can fog a mirror, is going to ask you to substantiate or prove many of your expenses. If you have a QuickBooks file, then chances are you haven't taken the time to make notes to establish a bulletproof alibi. For example, did you take the time to upload each receipt one at a time to match the accounting file? Probably not, because accounting applications are primarily built to tell you where you spent your money. They assume that you're keeping a good organizer and tax diary in addition to their software. That's their assumption. What a lot of people don't know is that a good tax tracker can actually replace a program like Quicken, but Quicken cannot replace a good tax tracker. And for this reason, we decided to build a mileage and expense tracker that meets both IRS and Canada Revenue Agency standards. And I want to help to make this easy to create your alibi. So let me show you a few quick points. Let me get to where I want to be here. First of all, I created it with, there's 3 buttons. You don't see the third button because it just came out. And it deals with trips to classify, expenses, and income, period. I designed this for me. I've learned something that if it's simple, easy, and fast, I'll do it. If it's not, I won't. So I wanted to do something very simple and easy that anyone can do. First of all, with Taxbot, you can automatically track your mileage for you, so you don't have to remember to do it. In fact, you don't even have to turn it on. If you're like most people, when you get in your car, your mind is focused on the next meeting. I know I am. Or maybe perhaps you're thinking about other things you need to get done or some looming deadline, but you're not thinking about tracking your mileage. For sure, I know that. With Taxbot, you don't need to worry about that. When you start driving, Taxbot will sense that you're driving and record the trip for you. It will automatically turn on. You don't even have to remember to turn it on. When you come back at a later time, you can see all your drives and classify your drives as business versus personal. And it has all the information that the government requires. Taxbot's interface is designed to help you quickly identify each trip. And by the way, just to give you an idea, each trip, or this is all automatic, you don't type this in, has a detailed map highlighting the exact route you take. You can actually see the route that you took. I can't think of any other expense tracker that does this, in fact. You'll get a full beginning and ending address, not just the city. If you had an appointment on your calendar around the time the trip ends, then Taxbot will automatically add in the calendar details to complete your alibi. If it's not on your calendar, you can easily add it as a business purpose and save it. You can also quickly merge trips. So let's say you did multiple trips. You can merge, like going on showing or tours. If you have several business appointments in a row, you can tap the ones you want to merge and then quickly put them in one description for the entire trip. I mean, all this is done for you almost automatically. Now let's talk about expense tracking. That's the integrated, so it has an integrated mileage tracker with a GPS system. It's really cool. And not all expense trackers are compliant, by the way. You may have read about a number of them, like there's one out there where you slide left and slide right. The problem is it doesn't ask you for the expense, for the reason, the explanation for the trip. That's a very important thing that you have to have. All it asks you is business and personal, and that's not compliant. There's a lot of surprised people when they do that. So let's talk now about expense tracking. Imagine we go out for lunch, and we do this for business, and I'll open up Taxbot. I'll snap a picture of the receipt. Then I'm prompted to fill out the information I need for my airtight alibi for tax purposes, and I click Save. It's that easy. You snap pictures, you fill out the information, and you never have to worry about an IRS or Canada Revenue Agent audit again. So it has an integrated expense tracker, and then it takes the camera that's on your phone and integrates that so that it takes a snap picture of the receipt. You don't even need the receipt. You can keep the picture as long as it's clear. So you can throw away a lot of that paper. But you can also connect your online banking to Taxbot. This is a really cool feature. Each night, Taxbot reconciles with your bank or credit card. Taxbot then displays the transaction that's not in Taxbot and allows you to import them. You can tap the ones you want to import, and it will ask you the alibi questions. This way you can make sure that you're not missing expenses that you might have on auto payment, for example. And by the way, I do want to mention Taxbot works on most smartphones, the iPhone, the Droid, the iPad, the Droid tablet, and the web. Works on those devices. And it works on multiple cars and multiple businesses simultaneously on one account. So let's take an example. Let's say you have a real estate business, your spouse is also in the real estate business, and you have a kid who's in another business. Maybe they sell medical supplies. All three of you can use Taxbot. All three of you get separate reports on one account. You don't need separate reports for each of you. I do want to emphasize that. I mean separate accounts for each of you. You will all get separate reports. And by the way, whenever you like, you can access all your records online at the website. You can view detailed reports with simply the click of a button. You can download an audit-safe report for your tax preparer by simply emailing them the information. You can download it to a memory stick and give it to them. The report will include a profit and loss statement, pictures of all your receipts attached to your documentation, and all the information you entered for your alibi. Let me tell you, I can't be held responsible if your accountant kisses you because you have the most complete records of any client they have, and I have been told that multiple times. Now, by the way, if history holds true, 90% of you on this webinar don't have an accounting solution at all. You're not doing it right. I hate to say it. Taxbot's going to be a no-brainer for most of you. But there's always that 5 or 10% of you that want to use an existing accounting system like QuickBooks. And the question always comes up, do I need both? The answer is for most people, a traditional accounting system is a lot more complicated than they need. It really is. And plus, it doesn't take care of compliance. Generally, a good tax tracking system is all you need. But if you're in a business that, say, tracks a lot of inventory, or you have a number of significant employees, then maybe you do need a traditional accounting system in addition to Taxbot. But if you're in this category, you can export your data from Taxbot and then import it into other accounting systems if you really want to use both. I don't think you have to for most of you. I think Taxbot alone will work. Okay? But the important thing to remember is don't do more work than you have to. Keep your life simple. I've always believed in that. Make sure you're collecting the information you need in case you ever have to prove yourself in an audit. You have the right alibis. Now, how much does it cost? The investment, traditional accounting systems usually cost anywhere from $300 to $500 a year on the low end. Taxbot is only $10 a month. And in fact, it's even less than that. If you get it for the year, it's $100 a year. And it's not even $100 because it's tax deductible. So on that $10, it probably costs you about $5.40 a month. What's that, about 18 cents a day for all of this? I mean, you can't beat it. To take advantage of it, go to www.taxbot.com. It's going to ask you for a coupon code. Type in the word RESAAS, R-E-S-A-A-S. That's R-E-S-A-A-S. Okay? And by the way, there is a very special bonus. We have a special offer for you. If you test drive Taxbot, and I want you to see how easy it is to use. It really is. I want you to have that peace of mind that comes with knowing that you are absolutely compliant. So I have a little incentive for you. If you sign up for a 14-day risk-free trial, it's absolutely risk-free, okay? Then I will upgrade you to a premium account pass for 6 months at no additional cost. The subscription allows you to email or call us and ask unlimited tax questions throughout the year. We have tax professionals that can respond to your questions for free. This is a service that we normally charge over $200 for in the year. But we're doing this as a special event that RESAAS asked us to do. If you want an upgraded subscription for free, all you need to do is sign up for your trial within 24 hours by the end of day tomorrow, because we're going to be shutting it off after that. So get your trial. It's 14 days, completely risk-free, and you will get an absolute 6 months of unlimited questions, all you want. And by the way, Taxbot, just for the record, has a 4.5-star rating in the App Store and is endorsed and recommended by almost every single real estate association in the country. They're endorsed and recommended by the National Society of Accountants for their clients and billion-dollar sales companies. But, bottom line, if you want something simple, easy, and fast, Taxbot is as easy as it gets, and it's fully compliant. That I can guarantee you. Okay, again, take advantage of the 14-day risk-free trial and get a 24-hour bonus to our Premium Pass access. Go on the link on the screen. And by the way, let me be frank with you. Hopefully the bottom line is you need to do something. You need good documentation. So if you give Taxbot a try, if you don't use Taxbot, fine. Use something. You want to do something else and get a fireproof safe? Fine. You want to use a notebook? Fine. But the bottom line is that you have to do something better at keeping your records. Okay? That should make, I think, a lot of sense. All right, let me do this. Take advantage of Taxbot again. You go to www.taxbot.com, coupon code RESAS. Hopefully I've convinced you of the horrible mistake of overpaying your taxes. And I apologize to anyone who doesn't get this because you're going to pay a lot more than those that do. All right, I'm going to turn this back to Rochelle. Let me take some questions. And if you have any questions, please write them in so they can ask us the questions. Rochelle?
Oh, thank you so much, Sandy. That was an incredible webinar. It's always action-packed with you. It's loaded with so much meaty content. I just wanted to go ahead and get into some Q&A from the audience. We have a few questions, but we don't have much time, so I'm going to get into the most important questions here.
Let me give one.
I've got a question.
One person asked, does Taxbot take advantage of the GST? We have all our categories. When you click on Taxbot, when you click on expenses, you'll get a whole list of categories. I don't remember if one of the categories includes GST, but if it doesn't, it's fully editable and fully customizable. So if the GST isn't there, you can simply add it, and it will be there, okay? So I do want to emphasize you can simply add that as a category, and then you'll have it for the rest of your life. So everything is editable and customizable. You can also go back to past months if you didn't input things in the diary and put it in there. It's all editable. Anyway, go ahead, Rochelle. I'm sorry. I didn't mean to steal your thunder.
Oh, no. You didn't steal it. That was actually the question I was going to ask. But I've got another question here from Katrina Scrow. She wanted to know regarding office supplies and real estate signs, how much is the deductible in that sense?
We're going to office supplies and what?
Real estate signs.
You can deduct 100% of your office supplies and any cost of your real estate signs that you place on your car.
Oh, fantastic. We've got another question. Okay. We've got another question here from Denise Connell. She wants to know, she recently traveled to the National Association of Realtors conference in a different state. She wants to know if all of that cost would be deductible.
All right. The answer is the travel is deductible. The real estate, the actual registration to the National Association is deductible. The only thing that there's a limit is 50% of your food. You can deduct 50% of your food, 100% of everything else. And that includes your dry cleaning. Not only is all your dry cleaning deductible while you're at the convention, but IRS has ruled that as long as the clothing got soiled there, you can dry clean them anywhere, and that's true in Canada too. So your first dry cleaning bill you incur when you get back home is 100% deductible as long as your clothing got soiled there.
What about the hotel cost, Sandy?
100%.
100%? Oh, fantastic.
Other than the food, which is 50%.
Okay. Denise, hang on to those receipts. We got another question here from Gail Garrity. How long does the IRS require that we keep business and personal tax records? Is there a minimum 10 to 7 years? Are there any limitations around that?
Here's the rule. Well, the good news with Taxbot is you take a picture and then we keep it. I mean, it's on the web. But the general rule is this. If it's an expense like a normal expense, marketing expense, things like that, it's 6 open tax years, basically, 6 years. If it's property, like you bought real estate or you bought stock or bonds or a car or things like that, then you kind of keep your records on that purchase price for as long as you've owned the property and for 3 years after a taxable sale. So if I bought a car in 2010, I sell it in 2017, I have to keep my records on that car, the purchase from 2010 to 2017, and then 3 years thereafter. But if it's a normal expense like marketing, stuff like that, the general rule is 6 open tax years.
Excellent. Diane Edward wants to know, can any of this be used for the 2016 tax season, which recently opened up?
Absolutely all of it can be used for the 2016 tax season.
Fantastic.
How's that for on point?
The timing is perfect. I've got another question here from, let's see, Natalie LeQuinto. She wants to know, she has 2 businesses. Is she able to manage both within Taxbot?
Yes. Taxbot works on multiple businesses and multiple cars simultaneously. What you do is you set up, maybe you might set up the first thing, but business 1 and then business 2. You just have to have drop-down menus on every single expense, even including the car. You just have to make sure that whatever business you're on, you put it on the right category. But other than that, you can set up multiple businesses, multiple cars simultaneously on one account. And if you have it, we have videos on how to do that. It's not hard. It's very easy. But if you have questions, you can simply call us up. You get real people. They live here in the United States and Canada. You don't have to speak to somebody who happens to be located somewhere in India or Mexico, wherever they are. They're right here in the U.S. They'll be glad to answer your questions.
Thank you so much, Sandy. I've got 2 more questions, and they both tie in together, so you can answer them both at once. First question is, dry cleaning costs a write-off? As well, can they deduct the cost of business suits?
All right. The normal cost of dry cleaning is not deductible. That's the normal rule. However, there are 2 exceptions. One is if you go to an out-of-town business trip, like a seminar or convention, a business seminar or convention, as long as the clothing got soiled there, then you can deduct the dry cleaning of it. The second exception is if you convert your outfit to a costume. Now, a costume, think of it like a medical smock, something that identifies what occupation you're in and who you're working for. So let's say, for example, you have a big logo stitched on a jacket that says XYZ Realtor. That jacket would be considered a costume because I know what company you work for and I know what business you're in, and the dry cleaning of that jacket would always be deductible. If, however, that logo is clipped on, then it's not deductible unless you're on a business trip away from home, because you can always clip it off and I'll never know you're in real estate. So you want to have a fixed-on logo, and that converts it to a costume.
That's excellent, Sandy. Once again, I just wanted to thank you for your time. This was an outstanding webinar, and I apologize to everyone we couldn't get questions to. We'll be sure to reach out to you after the webinar to make sure that we answer all of your questions. Sandy, thank you again. It's been an absolute pleasure.
It's my pleasure. Let's make everybody's life less taxing, folks. Take care.
Thank you. Bye-bye.